Hello, and welcome to the second episode of the King Street Journal podcast. My name is Jessica McGregor, and I will be your host. In today's episode, we will be covering three major topics shaping global markets and politics right now. First, we'll discuss the relationship between major technology companies and governments, how that relationship affects consumers, and what the future of these markets could look like. Next, we'll look at China's new 15th five-year plan, focusing on its push towards technological self-reliance and what that means for the global economy. And finally, we'll turn to recent geopolitical developments in the Middle East, including the strike on Israel and the reported death of Iran's supreme leader, and discuss how these events have influenced investor decision-making, global energy markets, and defence stocks. Now we are joined by Dan. How are you today?
I'm doing pretty good, Jess. How are you?
I'm good, thank you. So within your most recent publication for the King Street Journal, you researched the relationship between governments and large technology companies, looking at how this alignment affects regulation, consumer protection, and market power. Today, we will be talking about why governments have struggled to control big tech, the risks that come from growing dependence on these companies, and what the future might look like if these trends continue. So, Dan, you talk about how governments and tech companies often end up aligned, especially when data collection and monitoring serve both political and commercial interests. In that situation, governments may be less willing to regulate companies that are actually helping them achieve their own goals. Do you think this creates a structural conflict of interest where consumers end up with very little protection?
Yeah, absolutely. I think the case is that, especially in the US, but now because we have the biggest tech companies over here that collaborate with the West, so this would include Europe as well in this conversation. Because over here we've got the biggest tech companies collaborating with governments, we've got a lot of dependence from those governments on those tech companies. I mentioned in the article that there are a couple of governments, Germany, Italy, and so forth, that are trying to separate themselves, so creating some sort of digital sovereignty, whatever extent they can achieve that would be great for them. And they're piggybacking on open source software because the crux of the issue is governments and their reliance on tech companies means that they work at the behest of them. And it is no longer a case where the technological tools that were once, just avenues for efficiency back in even far back as the 70s. That's no longer the case anymore. It's similar to how we created cars to get from one location to the next, but now we've ended up creating civil infrastructures that span multiple hundreds of miles in even small countries, and you've got to the point where now you need a car to get around, and so you're more at the behest of the car companies than the local infrastructure behind you. It's the same case in governments, and because we rely so much now on the private sector, they've got a very strong grip on us that we didn't expect that they would have.
That's very interesting. That just kind of naturally leads on to another question here. Because of this conflict of interest, because it was visible even early on, why didn't the governments act sooner? So if governments were aware of this risk of surveillance, market concentration, and dependence, why didn't they try to restrain big tech earlier instead of integrating them into public services?
I think it's because in big, large, strong economies like in Europe, and I'm saying Europe really as the larger region, and North America, so that will be Canada and the US, because those economies are so strong and because they work in such a dynamic and robust way with other economies, governmental regulation is absolutely necessary to prevent the loss of wealth due to large-scale fraud or whatnot, and national security in general. Now, these are noble pursuits by Western economies and governments, and that's fine. But I think the problem is that in trying to establish cybersecurity, for instance, or the security of the economy, or the security of whatever securities market there operates in that country, they need a degree of surveillance that lends itself very well to any sort of campaign that relies on data to hold people, or rather hold incumbents in power. To put it simply, all I'm really trying to say is that real earnest efforts to improve the quality of life of people in these large economies required the adoption of advanced technologies that over time, once their requirement had been completed, remained to collect data that governments could continue to use for whatever agendas they wanted to push. Now, I also want to note that, I've mentioned only strong economies doing this, specifically North America. I live here. I can talk about that very comfortably about how, law enforcement or the federal government at large uses, for example, AT&T or Verizon's networks to surveil people. That's fine. I could talk about that. It's also definitely a thing at a smaller scale. It's just that when bigger economies like ours produce services like this, they lay out the blueprint for other countries like Pakistan, like Afghanistan, like Iran to use this similar technologies with a similar but adapted infrastructure there to surveil their people. And while we can nobly say over here in the West that their system is way worse, ours is a lot more covert and relies a lot more on much bigger companies that we just consider household names, and that's why we've desensitized ourselves to it. But yeah, I'm not sure if that answers the question, but ultimately the point I'm trying to make is that we've got so many systems in place. Naturally, it was always going to go towards helping out people who wanted to keep their position.
So, towards the end of the piece, you also mentioned the possibility of a broader economic collapse that economists have been warning about since the post-COVID period, particularly in relation to market concentration and the close relationship between governments and large corporations. Could you expand on what you think that collapse might look like and the consequences that would follow?
Yeah, for sure. So I don't think that simply talking about the AI bubble is sufficient to describing the oncoming economic collapse. I think that's certainly going to be a part of it. In fact, I think it's going to be the majority of it, but I think analyzing the principle of what's going on is more important here. What's happening is that the government is taking a directed stance to deregulate certain sectors. And depending on your political affiliation, that could be a good thing. I know I for sure do call for deregulation in some fields, and that's fine. My problem is that when you're deregulating industries that specifically serve your agendas, especially if those agendas are not just political but involve power and that they keep you in power by eliminating your competition in the democratic market, so to speak, that's a problem. If your entire election cycle or your government structure is based on democracy, limiting democratic opportunity is a big problem for me, and it should be a problem for everybody. Now, as far as the economic collapse goes, I think that's going to be a part of it. So, if the government deregulates industries and businesses that help keep them in power, those businesses are going to end up having more monopolistic controls over their consumers. And what could once start as consumers investing in products and services that become necessities in the modern world, it turns into an exploitative relationship where companies are unregulated at all. They're allowed to charge whatever they want and hold whatever market share they want and essentially substitute the entire market. I always go back to sports because it's very, very, very simple principle to understand. You've got the biggest basketball league in the world, which is the NBA. And that's fine for sports because sports is fairly low stakes. But when you're talking about surveillance, privacy, the financial fabric of every institution that we have in America in general, it becomes a big problem. It becomes a very big problem. So that's my main concern is that they're going to get monopolistic control. And I always talk about monopolies. My last piece was on monopolies. Antitrust law is my specialty. So I can for sure say that when you give an industry monopolistic control over the market, it's going to radically change how consumers choose to invest their money. And I'm not just talking about securities here, I'm talking about everything from groceries to movie tickets, right? When people have to pay implicit and explicit costs as a result of large economic changes due to deregulation, their behavior is going to change and they're going to get a lot more frugal with their money. That's going to reduce spending and thereby reduce opportunity for the private sector. And the less opportunity people have, the greater unemployment rises. That's how you get inflation, and things only go down from there. Very hard to come back from that. And really, the only way to do so, as we have set a precedent for in the US, is to bail out big financial institutions. Doesn't really solve the problem for the common man or woman. So this is a central issue to American financial freedom and so forth. So it's a big thing.
Thank you, Dan. You hit some really interesting points there. It was really great to have you on this episode of the King Street Journal podcast.
We are now joined by Apurbo. How are you today?
I'm good, thank you. How are you?
I'm good, thank you.
In this section, we're going to be looking at China's latest 5-year plan and what it could mean not just for China's economy, but for the global economy as well. These plans have always played a major role in shaping China's long-term strategy, but this one seems to place a much stronger emphasis on technological self-reliance and reducing dependence on the rest of the world. So, in your article, you talk about China's new 5 year plan, focusing heavily on technological self reliance, especially in areas like semiconductors, AI, and biotech. For listeners who might not be familiar with these plans, could you start by explaining what makes this one different from previous 5 year plans and why this push for self reliance is happening now?
To answer this question, I think I should first talk about where the idea initially arrived for the Chinese 5 year plans. So, these plans initially were taken from the three Soviet 5 year plans, which was devised by Joseph Stalin. And for the first 5 year plans of China, Joseph Stalin was involved himself. The Soviet 5 year plans were devised so that the Soviet Union, which was way behind the other European powers of the time, could catch up industrially to the powerful Western European countries. Even though it did have a lot of negative side effects, mostly famines, it had a lot of good effects as well. For example, being industrialized in quite a short time compared to the other countries. So at that time, the Chinese leadership under Mao Zedong thought that it would be a good model to follow in order to improve their own economy. So their first 5 year plan was quite successful, which focused on heavy industrialization, Soviet style central planning, and agricultural collectivization. And by 1956, China had completed its socialist transformation of the domestic economy. The urban populations had increased from 57 million to 100 million between 1949 and 1957, and life expectancy had risen from 36, just 36 to 57 years. Not a lot, but a big jump. And urban incomes also increased by 40%. However, the agricultural collectivization that they put into place strained the rural sector a lot, meaning the agricultural. So, yeah, the grain production failed to keep pace with industrial and population growth that happened. And the effects of the agricultural collectivization hit the Chinese economy during the second 5 year plan that they implemented, because the administration directed all the resources towards industrialization, which meant millions of people who were farmers before left the agricultural sector and joined the industrial sector. Industrial sector, as in, joined the plan of industrialization, which meant enough food was not being produced for the people. While population kept on rising and rising, the food production kept on going down. So that caused a huge and devastating famine. And right after the famine, meaning right after the second 5 year plan, was called the Great Leap Forward. So the economy was quite volatile afterwards, mainly due to the agricultural sector like shrinking, population increasing, and also the Cultural Revolution implemented by Mao Zedong. However, the economy picked up its pace with the fifth 5 year plan under Deng Xiaoping's reforms, which focused on economic modernization under four pillars of modernization, which Deng Xiaoping coined as agricultural modernization, industrial modernization, defense modernization, and science modernization. From the sixth 5 year plan onwards, the Chinese economy grew rapidly with the highest GDP growth rate in the whole world, and it became the economic giant it is right now, from having close to 500 US dollar GDP per capita since its beginning, which made it one of the poorest countries in the whole world, to now in an aggregate way, in GDP terms, it's the second strongest economy in the world. And GDP per capita is higher than 10,000 US dollars right now. And now to finally answer your main question, like this was just the historical context till now. To answer your main question of what makes the 15th 5 year plan different and why is it implemented right now rather than any other time, is what makes it different is its goal of national technological security rather than industrial growth. In all the other 15 year plans, except the 14th one, the main goal was industrial growth, manufacturing. They kept on hammering on the same nail. But now the goal is for national and technological security, because it is, in a sense, a continuation of the 14th one, which was about tech self reliance. But this one has an increased focus on the semiconductor chip manufacturing and AI, and China is focusing on it now more than any other time, is because of the ongoing semiconductor trade conflict it has with the USA, as USA is imposing trade restrictions on China so that China's tech cannot exceed their own ones.
You also suggest that this push for domestic technology could reshape global trade and supply chains. If China does become more self sufficient, what kind of impact could that have on the global economy, especially for countries that are currently part of those supply chains?
That's an excellent question. So, if China succeeds in this 5 year plan, then the countries and companies which are currently supplying China with semiconductor equipment, materials, and advanced components, like the countries in East Asia, the European countries, and the United States, would face a shrinking demand from the world's largest manufacturing economy, because anywhere you look, you see made in China. So if China becomes self-reliant in this field of semiconductor chips and tech reliance, a lot of countries and companies supplying them would face harm, which would mean that the regional supplier networks would need to restructure. Foreign direct investment or FDIs into China from other multinational companies could also go down, as domestic producers would be favored through these policies and subsidies of the 15th five-year plan, and it would reduce competitive space for international firms. However, there is a catch in this. If China creates protected national champions, like champions, but they're protected through heavy subsidies rather than firms which rise up on their own with their own goal, own strive, own determination, it could produce more factories without improving the overall efficiency. That scenario would mean less disruption to the global supply chains, but also more trade tensions, as other countries will push back against the subsidized exports flooding global markets, the subsidized Chinese exports flooding the global markets, which was also caused by the Made in China 2025 initiative, like the ones I was talking to you about just a while ago. Like everywhere it's just made in China. So when the cheap Chinese product flood foreign economies, the governments will push back because their own countries are getting harmed by the cheap Chinese imports.
If this plan is successful, what do you think China's economy could look like by 2030? And if it fails, what would be the biggest consequences?
Yeah, this one is like the conclusive question to end the discussion. So we can continue to build up on what I said before. So if the plan is successful, China's tech sector could emerge even stronger than it is now, making it more self-sufficient in semiconductors and AI technology. China's R&D spending as a share of GDP is already in the mid 2% range. Like I have already shown this in my article with a diagram, how much it spends in R&D as a share of its GDP every single year, and it has been rising, and it's now in mid 2% range. And this gives a head start to this new 15th five-year plan. So it already has a strong foundation to build this 5-year plan on. And if it fails, then domestically, China will end up with a bunch of tech firms which rely on government subsidies to keep them afloat rather than their own competitive edge. And internationally, as I've mentioned before, it may cause other countries to put even more restrictions on China's access to semiconductor technology and markets. So the main discussion here is, if China succeeds, then it could possibly be negative for multinational companies which supply China with the raw materials.
Thank you so much for joining me on this episode of the King Street Journal podcast.
It was my pleasure to be on this episode. Thank you for having me. It was a pleasure discussing my article.
So now we're joined by Aish. How are you today?
Good afternoon, Jessica. I'm doing perfect. Thank you very much.
So, your most recent publication focused on the relationship between geopolitical tension, commodity markets, and investor behaviour, particularly looking at how oil prices, defence stocks, and inflation react during periods of global uncertainty. I just wanted to start by asking how markets are interpreting the current situation. So, future curve is signalling short-term supply risk rather than long-term scarcity. Do you think the rise in oil prices will eventually affect consumer inflation, or will the change remain mostly in production costs?
So, mostly it will stay in production costs during the short term. However, if it persists modestly, then it will, kind of bleed into consumer inflation through effects like transport and food. So, the real question is, whether central banks, see this as a noise or something that risks de-anchoring expectations.
And why are markets treating this as a temporary shock rather than a long-term supply disruption?
Markets are pricing this as geopolitical noise rather than structural disruption. Basically, it's assuming that supply routes stabilize before the demand dynamics are fully affected. And, markets have become very good at fading geopolitical risks, but that only works until it doesn't last as long.
We have seen that during periods of geopolitical tension, defence contractors like BAE Systems and Lockheed Martin often rise in value, while investors also move into energy stocks as oil prices increase. This reflects a wider reallocation of capital away from consumer sensitive sectors towards industries linked to government spending and essential resources. Why does energy and defence tend to act as safe havens in these situations, even though they are still part of the equity market?
Because revenues are either tied to inelastic demand, the steep demand curve, like energy, for example, or backed by government spending, like defense. So it's insulated from typical demand shocks hitting the wider market. What we're seeing here is repricing of geopolitical risk across asset classes, not just a short-term rotation.
So, looking back at the market reaction to the Russian invasion of Ukraine, the initial shock to energy prices was expected to be temporary, but it turned into a much longer lasting supply disruption that pushed inflation higher and forced central banks to tighten policy more than expected. If the current tensions were to become structural in the same way, what kind of economic consequences could we see this time?
Yeah, so if it becomes structural, there will be a persistent inflation. So for on trading, you will see different stock prices and all prolonged monetary policy. So that's the cost of credit, interest rates. That would be a larger shift towards supply side fragmentation. Fragmentation essentially breaking it down on process in multiple stages managed by various suppliers. So essentially reversing some of the gains from globalization. This isn't just about inflation, it's about a structural shift in how the global economy is organized. I did recently see, um, moving forward into a little more into this answer, I saw, Patrick McDavid's, he's an entrepreneur in America. He basically put out a video. The title is Iran's Future, a Regime Collapse or a Change. He was basically talking about the historical implications, the likely scenarios and future, etc. He puts into 8 possibilities. The 8th possibility being net positive means Iran becomes culturally, it's a cultural paradise, or the first, most extreme would be negative, basically nuclear destruction and all-out war. But he came to a conclusion that Iran will be in a military coup, or a military dictatorship, kind of what he generally kind of concluded as. So it's all basically interesting. He talks about all this and the intentions, the implications, and the governments, etc. So it was just basically kind of generalizing, in kind of retrospect, how the whole uh, prolonging effects of this nuclear talks with US and Iran, and then how it became into this, war on the 28th of February, I remember now, and then kind of this whole kind of discussion that he had in this video. So it was just thoughtful for me to kind of mention in this part of the podcast now.
Thank you so much, Aish.
Thank you. Thank you for having me, Jessica.
This is it for this episode of the King Street Journal podcast. And if you want to read more on these stories, be sure to check out our website at www.elphinstoneresearchgroup.com. Thank you to our guests, and thank you for listening.